agents, when we talk about captives, you know what I think? Agents don't understand the process more than it is the mechanism. We see independent agents as our clients, right? Not the business owner.
Too many people think that the captive is the answer to help them get better. It's not. It's the reward for already being good.
I want to put agents in a position to succeed and win in a place so they don't have to go do what I did and lose their, top client, because that really sucked. And I don't want to see people do that. And then now go build a book, go build a really solid book of business with captives as a strategy instead of playing defense. Because look, if you're not talking about this to your client, somebody else is.
The carrier loves it, man. 17% loss ratio. I mean, come on. Why wouldn't we want you in our $50,000 deductible program?
There's two kinds of insurance that we add to the captive. We have a specific and aggregate excess coverage, and that protects the captive in two ways, right? Say we all have a bad day and we have huge severity losses, or we have a bad day and we have huge frequency losses. So it protects the captive from running out of money.
It doesn't matter if you're talking about captive or guaranteed cost. Quit asking for the frickin' deck pages every time you go out and ask for the loss history. Who cares what's on the deck pages? That's telling you the result. Go get what the story is. Go look at the loss runs and read what's actually happening. What's up, everybody? Welcome to the Power Producers Podcast, where we are refining and redefining the sales game. Today, I'm wearing the Bucks pewter because the Lightning got absolutely destroyed last night, and I'm going to boycott them for a day. But I'll be back on the bandwagon again tomorrow when they have the second round of the playoffs. But I got a good guest today. You know, we've talked about it both in one-off and a lot of people over email asking who I know that can help them understand captives better or even place business in captives. And as a result, I've had a couple of guests over the course of the last several months and even, a couple last year where we've talked about it. But my guest today has a little bit different perspective, and we're going to dive into all of that. It's Warren Cleveland. He is the founder of Captive Coalition, and he has a bunch of tools and resources that will help you help your clients save money and ultimately add profit to the bottom line. Warren, what's up?
David, thanks for having me on, buddy. I really do appreciate it. And we might get some good barbecue tips out of this conversation.
We might. I don't know. It's possible. Are you a big barbecue guy, or have you been stalking my social?
No. Somebody told me about it, and I'm like, oh yeah, we got to talk. I'm a huge fan of Amazing Ribs, Meathead. That guy, he makes it's great recipes, good community.
Yeah,
I'm always up for making barbecue.
Yeah, no, we like to cook a lot, actually. I didn't get fat by accident. It's much harder for me to take the weight off, but we my wife and I were actually in Italy back in February, and we were headed back. And it was an amazing trip. Everything was awesome in the whole trip. But she asked me, she said, what was your favorite thing? And I said, hands down, the cooking classes. I mean, we saw all this amazing history, all of the art, all of the, architecture, everything. We went to Rome, we were in Pisa, we were in Florence, and we stayed in the village of Cortona for 3 or 4 days. But out of all the stuff that we did, the coolest experience we had was a cooking class we took with a Michelin star chef in her Tuscan farmhouse, just me and my wife. Like, she picks us up in her car, which was, by the way, a Fiat. So I'm 6'4" for those of you who are of the group of the group that always sees me in person when I speak at a conference and says, wow, you're a lot taller than I thought you were. Like, well, yeah, you see me on a podcast sitting in a desk chair, so you really don't have a good gauge. But I'm crumbling. I'm like contorting myself to get into this Fiat to ride over to where we were taking the cooking class. And she says, I have to apologize to you, but my commercial kitchen is closed. It's not really season here. I hope you're okay with me taking you over to, I will just cook in my kitchen in my home. I have a farmhouse right down here. Like, this story just got exponentially better, and we haven't even started yet. So it's everything you would probably imagine. The village of Cortona, where we were, is where they filmed the movie Under the Tuscan Sun. So a lot of the scenery and stuff you see in that movie, we were there. But she took us to her home for 3 hours, taught us how to cook like 4 or 5 different things, and we ate that for dinner. And dessert and all of that, and we brought the skill set back with us. And I think that was the coolest part about it, man. It wasn't necessarily just the experience of having the cooking class and learning how to do that, but the fact we could bring that back with us and replicate it here. And we have. I mean, the first 2 weekends back, we had family and friends over and made these massive, authentic Italian dinners for everybody. And unfortunately, I'm one of these people who's a purist. If the ingredient needs to come from Italy, then I'm going to get the ingredient from Italy. So I dropped like $1,500 on the plane ride back, and I got these massive wheels of pecorino romano and parmesan reggiano cheese and all of the
Oh,
different sea
so
salt
good.
spices and all of that stuff that we cook. But most weekends you will find me at the smoker doing something. And I mean, there's 6 of us that live in the house. I'm an ex-grocery guy. I understand the 16-week ebbs and flows of the different cycles. And so I stockpile when I buy so that we can ride the pricing wave. And I have every commercial gadget you can imagine. I've got a commercial slicer, I have a commercial vacuum sealer, I've got a commercial sausage stuffer, like all of it.
Oh yeah.
100%. All of it is way more than what the average person needs, in their home. But I'm also a big believer that you spend the money on the tool, you get the job done faster, and you get it done the right way. So, when we go out, for example, I don't just like make a Boston butt for pulled pork. I make like 12 Boston butts at a time for pulled pork. Then we pull it, vacuum seal it, and I don't have to smoke Boston butt for another 3 or 4 months at that point because it'll take that long to go through it. So, yeah, we do a lot of barbecuing, a lot of smoking. I follow a bunch of different people online, man. Instagram has certainly made it a lot different than what it used to be. YouTube does too, but one of the things that I've picked up, and then we'll get into talking about captives, and I'm sharing this for everybody because I never even knew this was a thing before, but I happen to see this reel on Instagram to do smoked ham. Now, I'm not talking about fresh ham. Like, I know all about fresh ham and where that comes from on the pig and all of that stuff. I'm talking about the nasty old shank portion salt ham that grandma used to cook that you could barely get through without, it was so dry or whatever. You can actually smoke that, and it's some of the best barbecue you will ever have in your life. So I have gotten this thing perfected now. And a couple of weeks ago, both Publix and Winn-Dixie had hams on sale going into Easter. So I called them the Four Horsemen. I did 4 hams in one day. And basically, you smoke it at, I want to say it's like 225 or 250 till you get it up to about 170 degrees, I think. And then you braise it. You put it into a pan, and they tell you to do braise and glaze, rather. They have you do water. So my glaze I made with a jar of all natural peach preserves with a stick of butter and
Oh
some
my gosh.
barbecue rub. Okay. And then that
So
seasoned
good.
it, dumped that over the top. And then I put each one in an individual aluminum pan to braise it, as opposed to wrapping it in the peach paper or whatever. And instead of using water, I used that Jumex mango nectar to braise it in. So it's like a peach mango flavor when you get it, but it's just very, very subtle. But I'm going to tell you what, man, like you take that thing out and that bone comes right out of it and it just falls over and a couple of, shreds with your hands and the whole thing's done. And it's absolutely amazing if you eat that with the horseradish mayo that you can get at the honey baked ham store. That's the secret ingredient. I'll eat a bowl of it or I don't try not to eat too much bread these days. I'll just put it on in a bowl and eat it that way. But man, is it good. I could do a
Yes.
podcast on barbecue every day.
Invite me. I'm all in.
Yeah, but that's a really cool one, man. If you've never done it before,
I've
I wasn't
never.
sure what to expect, and lady said you'll never look at ham the same way. She's 100% right. It's absolutely amazing. It's some of the best.
I have to
It is not an actual. It's not like a traditional barbecue flavor. I think that's what makes it really cool. But
Yeah.
anyhow, so let's talk captives, man. I mean, we could talk barbecue. What's your background so that everybody kind of knows where you came from and how you got to where you're at now?
Well, it's a cool story. It's cool in that looking back on it, it was it's quite an adventure, but getting here has been something, right? So, here I am, 17 years old. I had a pilot's license in high school. my whole goal was to be airline pilot, right? That's my, that was my goal from day one. And so I got that, I went through the commuters, and then I got hired with Continental, and then here I am. I'm flying 757, 767s, and 9/11 shows up. And, thankfully, my friends were still around, but, tragically, a ton of people died. It was awful. And I lost my job, along with about 6,000 other pilots that day. Well, about 2 weeks later, October 1st. So I had to go do something else because there were no flying jobs. So I had to pivot to be an entrepreneur. That's not anything I ever planned on doing or being, right? So I've realized that there was something in there that I could hunt and gather, so to speak. So I opened a real estate business and did really well with that, and then transitioned into insurance. And as a scratch built a scratch agency. Actually met your dad several years ago, which was super cool. Very risk management guy. Found a mentor, and really quickly just got into the whole commercial thing. Realized how important that was, and found that it's this ping pong game that we play. That my market, that market, all this other stuff. And I got super frustrated with it. And I had this really large client, like 300,000 revenue client, and we knew the wolves were circling on this, and I had to go figure out a solution. So I called my mentor. I'm like, hey, what do you got any ideas? Like, there's nobody to take this. This is a London kind of thing. And he's like, you need to go check out a captive. And I was like, okay. And so I did that, and I turned around, and there was nowhere to find information. Like, there's no training. I called the usual suspects that we all know. They couldn't help, and it took a lot of digging, and eventually I found one. But the bad news of that was the day of the renewal. So asking Wall Street firm to spend $5 million in that it was done. It was over. I lost the account, but it taught me a good lesson, right? Always be learning. Two, I was never going to let that happen again. I hate losing more than I like winning. So my deal was, I dedicated myself to learning everything there was to know about captive insurance, and quickly found that it does not exist. It does now, but I created it. And the trouble is, it's not designed to help the independent agent, which I was, and I was frustrated. So, we kind of pivoted the agency. I was going to focus on captive business. And then, we had content, we had all kinds of things that you would do to grow a business like that. And then I realized something that, I'm a big believer in, give a man a fish, feed him for a day, teach a man to fish, feed him for life. And I took that same kind of adage, and I said, we could teach independent agents how this works and have a really great time, and show a ton of success, and share that success with a bunch of agents, and showing them how this works. Because you can look. I've submitted captive business to pretty much all the players that you would think of, and ultimately, it either happens or it doesn't. But you're not really part of the deal. You're not part of the process. They don't make you feel like you're in the deal. And that's when I was like, okay, we're going to do this on our own. So when I set my mind to something, that's kind of what happened. And I finally decided, all right, we're just going to open our own captives. We're going to teach agents how to do it, and we're going to help them be the hero of the story. And that's what we've done. So Captive Coalition is designed 100% around the independent agent, to show them, kind of like what you did in Italy, right? You went, you got educated, you came back, and now all of a sudden you get this great skill set that you didn't have before. Well, that's what we want to do with agents. We want to show them how it works, make them part of the deal, make sure they're included. And so we see independent agents as our clients, right? Not the business owner. Those are your clients, right, David?
Yeah, no, 100%. And I mean, I think that's one of those things where a lot of times agents may feel a little bit less inclined to move toward a captive for a couple of reasons. Number one, they don't know what they're doing. Although never stopped an agent from going after a kind of business, out there on the streets. Oh, I don't know what I'm doing, but we'll figure it out along the way, right? So that's probably not the biggest obstacle, but agents like to get paid. And I think that they probably don't realize that there is a way to make themselves relevant in the process and still monetize that relationship while, giving the best advice that they can to their client or prospect if that means moving into some sort of alternative risk transfer. What a novel concept, actually getting paid to give the right advice as opposed to just
Well,
selling insurance policies.
agreed. And this is what, this is what I call a hamster wheel, right? The insurance carriers that we're typically used to talking to, write this. Here's our little box. We want you to write this. And then they change the box without any warning. And all of a sudden you got to go figure, you deal with the collateral damage. But the problem is your clients are also stuck in that same cycle. And it frustrated me to no end that I was like, I just threw my hands up and said, I don't want to do this anymore. I want to go to a place that my clients, and now teaching agents this, that they can never ask me, why is my premium going up? Right? You can look in the mirror. You see exactly what your losses are. So when your premiums are tied to your loss history and we can help you get better, then everybody wins, right? The agent gets smarter about loss control and helping that business owner in a way some agents, not all of them, understand how that works. But now the business owner can have pride in the fact that they're spending all this, they're spending money on their business to get it better. It's going to be directly reflected in their premium. And that's what it's all about, right? You need the coverage, right? And we all get that. But let's have it like you could do all this great risk profile improvement and whatever, but an underwriter sitting at a desk in Texas, do they really care if they have to go give you an increase because of whatever? I mean,
Right.
the carriers have to make more money. It's simple as that.
Yeah, I mean, it's the whole thought process of the fact that you're performing well to help the carrier subsidize those who aren't. So why
Greatest form
wouldn't
of
you want to be in
socialism.
a program where you perform well so that you can drop your own costs and continue to perform well in all areas of your business? But I mean, that to me, that obviously it's a benefit of a traditional insurance program is you're not necessarily taking all the risk, like the carrier's taking the risk, but you're paying premium in exchange for that. But you also can control some of that based on the fact that you're pooling with other people. The absolute best operators don't care. Like they want to be rewarded for what they're doing, and they
Yeah,
feel that their
their effort.
processes and things are in place at a point where they're willing to bet on themselves. And guess what? You set up a captive the right way, most of the time it works out in their favor. Now, the problem is, I don't think agents, by and large, understand who's great for going into a captive and who's not. I think too many times you'll hear people, it's like the company that's got the 1.7 mod in their idea is we're going to go into a PEO so that we can get rid of our mod, and when we come back out we'll either take the mod of the PEO or we'll be at a 1.0 depending on what the rules are with the carrier and the state we're in and all of that. Well, that's great, and it certainly works for the short term. The problem is you do nothing to fix the root cause of the issues that got the mod to a 1.7 to begin with. So you get vacation from it, and you're probably going to experience increases inside of that PEO relationship because you've not done anything. And let's call it what it is, man. Most PEOs tell you they're going to give you a ton of loss control, and you never hear from them again after the deal's done. So you're not getting any assistance on that side either. And captives are no different. A lot of the times when people are asking me where who can I talk to about a captive or where can I turn, my first question is tell me about the risk you're looking to place in it. Like what's going on? Well, they've had a couple of bad years. Okay, don't even tell me anymore. It's not the time to go into a captive. I want to know I want to know how well they perform, over the course of the last 5, even 10 years if you can get it. Good grief, it's like pulling teeth to get 5 years worth of lost runs. Imagine asking for 10. But the second piece of that is it's not even just that. It's what have you done to take any kind of active risk, take retained losses, active retained losses in your company to begin with. If you ever even been on a small deductible program, let alone a medium or a high deductible program, before you're ready to push all your chips to the center of the table, let's talk a little bit about what you've done to prepare you for this. Too many people think that the captive is the answer to help them get better. It's not. It's the reward for already being good.
Couldn't agree more. I would caution about losses, and that is, look, we know 1 out of 5 years a company's going to have a bad they're going to have a bad day, right? Good things or bad things happen to good people every day, and that's just going to be what it is. It's if you're asking me, and I have three key things here. If you're asking me, how do I evaluate what my would my client be a good fit? Not only is it the financial piece, because that is pretty important, but it's also a mindset, right? So if you have a mindset that you're willing to take a little risk on yourselves, meaning the management, the owner, whatever, whoever's driving the ship there, they have to be willing to be entrepreneurial. And most are, but not all of them, right? I've seen businesses who, they're just as fine writing a guaranteed cost check than taking a risk in a captive, which by the way, isn't all that risky. I mean, I scratch my head when people, oh, it's this big scary thing. Once you understand the good and the bad, and you go into with eyes wide open, it's not that scary, to be honest with you. But two, do you believe as management, training, risk management, and safety are important to your business? And do you invest the things that you need to do to make that happen? And if you don't think a risk manager, if you're, 2,000, 3,000 employee company and you don't have like risk management team or staff, or, you don't have safety committees and toolbox talks and all these other things already established, captive's not a good idea for you, right? Because and I can almost guarantee that'll be reflected in your losses already. I mean, between you and me, that 1.7 mod, that's an absolute no. Like we're never going to do that. You get that sub one and you trend down, and to your point about,
But Warren, it's a shock loss.
well, I mean, look, I see it all the time. I see a shock loss, and then agents are like, well, look, this is what happened. I had a bad deal, but there's only been one in the last. And to your point, the last 5 years. If you can get 10 years of experience, you're dead spot on with that. Getting 5 years is like pulling teeth, but that we need that because we're building an insurance company, right? We're not. This isn't just shopping it to an underwriter who's going to put it in a model in their computer and outspits what the premium is. We're literally going to build an actuarial model around those losses. So the sooner we the valuation date needs to be right up on when we're talking captives with that business owner. But really, the agent has to be in a place that they can talk credibly. I mean, look, do they have to know aggregate attachment points and what that means and how that makes collateral more expensive or less expensive? No. Can they have a general working idea? That's probably smart, right? That's what we want to do. We want to give them enough information so they can feel credible, because agents aren't going to sell something they don't understand. I know I wouldn't. I'm pretty sure you wouldn't. So
I'd make the argument they sell stuff they don't understand every day. They just don't realize they don't understand it.
That's probably fair, David. That's probably fair. But look, I wanted to help an agent. I want to put agents in a position to succeed and win in a place so they don't have to go do what I did and lose their, top client, because that really sucked. And I don't want to see people do that. And then now go build a book, go build a really solid book of business with captives as a strategy instead of playing defense. Because look, if you're not talking about this to your client, somebody else is. And I guarantee it will happen. And so, coaching and training agents to go from zero to hero, you know, it does take time, right? You have to invest a little bit of time, but it's not insurmountable, right? At all. I give 3 webinars to our first tier members that, by the way, you're all your listeners, like we'll give them a free learn membership into Coalition so they can start this journey, and I've got people in there that have done, 10, 12 placements, and I've got people who have never done one at all, and they're just kicking it off. So that's the idea, is you got to get to a place where you can talk credibly in front of a business owner. And then when it's time, you bring us in. We're your partner in this deal, right? I'm here to bring captive insurance to you, not you're going to bring it to your client.
So what are some things? I'm an agent on the streets, I dabble in middle market. I've written some decent accounts, and I've got a couple that seem like they're inching up there in premium, and I'm getting a little nervous that I'm going to be on the radar of the big boys and girls out there, getting, not quite to 1 million in premium, but not too far away from it. What are the things I need to be listening to to know, you know what, I probably should pick up the phone and call Warren on this because this is starting to get to a point where I think maybe they need to talk to somebody about a captive. And I remember hearing him on a podcast. What should they be listening to that are the triggers of it's the right time?
Well, I mean, honestly, if you get to $1 million in premium and you haven't already discussed a captive, it may be too late, right? You want to be doing that in the three, four, $500,000 range, comp, GL, auto combined for a group. That to me, they've been pinged several times about captives, and they probably know more than you think they know about it. But look, every business owner I've ever talked to hates buying insurance, most of them, right? 99%. So, man, we just don't feel like we get any value for our spend. Like, are there other options? What else can we do? When they're trying to figure it out for themselves, which they're smart people to grow a business that they're spending that much money on coverage. You need to be the one to provide that solution, right? And it's super easy, right? It's super easy to make this happen. Getting on a call with us, having to talk about I mean, look, I've had plenty of phone calls where agents have called me and said, "Hey, look, the mod's terrible. The losses aren't great. We know this is not a fit. Would you help us get on a call with us and our client and talk them through the mechanism? It doesn't have to be 10 hours of work here, but would you help walk them through why this is not a good idea?" Absolutely 100% of the time. Because I want that agent to be able to save face and continue rehabbing that account to then bring, there's no better account in the world than somebody who's been like up high 1.7 mod or had a bunch of GL losses, who has fixed it and is coming down. That's a great account. Like, we want that account because they've already seen how bad it can be. They want the nirvana. They want to go the other direction, right? They've gotten religion, if you want to call it that.
So, what about the things they should be listening for that scream, this isn't somebody that I would stick in a captive?
Yeah,
Aside
that's a
from the
great.
1.7 mod. I mean,
Yeah, I just don't feel risk management does any good. Like, I don't think training fixes our problem. When you see a trend of years of service between 0 and 2, and 50% of your losses are coming from that, and they don't want to address that problem, that's probably a good sign. And even though you brought it to them and say, "Hey, this is a problem. We need to fix this. Let's work together. Let's figure this out." And they're like, "I don't think we can change it."
by the way, guys, for those of you who didn't follow what Warren just said, I'm going to break it down for you because I think it's something that's extremely important, especially if you are operating in the middle market. You got to understand how to read loss runs and make that data speak to you, right? So when he's talking about years in service is 0 to 2 and 50% of the claims coming from that time frame, it could be GL, it could be workers' comp, it could be auto, it could be any of them, but it's essentially saying somebody's taken a look at the loss data, they've classified it and tied that loss back to hold individuals accountable for whatever that loss is, and then they're cross-referencing it back to their tenure. And it usually ties back to the fact we do a really crappy job of onboarding people into our companies. And once we do get them onboarded, there's no training or ongoing training. It's literally, no, we're going to have you ride with Billy today. He's our best plumber. And by the time next week rolls around, you should be ready to do pretty much everything we do. But there's never anything about manual material handling and team lifts and all of that stuff. So, oh, we have 4 lower back injuries, and every single one of those people has been employed less than a year and a half. I mean, that's why I say all the time, it doesn't matter if you're talking about captive or guaranteed cost. Quit asking for the frickin' deck pages every time you go out and ask for the loss history. Who cares what's on the deck pages? That's telling you the result. Go get what the story is. Go look at the loss runs and read what's actually happening. We just went through this exercise with a company we are actively talking to about getting ready to move into a captive. They're spending 1.2 or 1.3 million a year in premium. Mind you, we haven't had this conversation because we were not the incumbent and still kind of technically aren't, but also are because we know what's coming. And the reality is, we're the other people that are talking to them about the captive because their agent's not. Now, we went in and looked at this company and we've tried to figure out what's going on. They're in an interesting model. We're going to just say they were a general contract. They're a general contractor, even though that's not what they're at, but they do have 100% sub exposure for all the labor. They're essentially clerical sales, and that's it at the corporate office. They sub everything out. They're paying 1.2, $1.3 million a year for insurance. On the general liability policy, they have a $50,000 per occurrence deductible. So when you look at the loss ratio with the carrier, it's like 16%, but none of the losses under 50 grand are going against the loss ratio because carrier's not coming out of pocket any of that money. They're spending another 1.2 million a year out of pocket in claims. Okay. So we start digging into this and we're like, what in the world is going on, man? Like, this is absolutely nuts that this is happening. Talk to me about your formal subcontractor agreement. Well, we have it and here it is, and they send it over, right? And we will not accept certificates from company A or company B. Many of you know who company A and company B are. They're like the markets of last resort for all of us in E&S, but they're not going to take them because they're a nightmare in claims and a lot of the coverages aren't there or whatever. So we're at a live call with these guys and said, why don't you send over a couple certificates just as a sample so that we can see, because obviously we're going in and saying you have an issue with certificate compliance. You know, if the claim is getting passed through your subcontractor to you, we need to understand why you're not additional insured, why there's not waiver of subrogation, why their coverage isn't primary and non-contributory. And, you know, or did they even have insurance? What's going on? First two certificates they sent over, guess what? One was with company A, one was with company B. Nobody was even looking to see whether or not the certificates are in compliance with what the subcontractor agreement says. And so we start looking at all the different things that need to be done to get them ready to go. And the reality is a couple of software solutions and the understanding that there needs to be a little more follow-up than just asking for the certificate and checking the boxes. They're going to be a perfect candidate to move into a captive. Their out-of-pocket expenses are going to be almost nothing by the time we're done putting all of our processes in place. But they would have just kept paying it because, well, we'll just outrun it in volume. And it's like, you've got to be kidding me, man. I don't care who you are. $1.2 million of cash going out of your pocket when it doesn't need to be is a huge amount of money, especially when it's in addition to an equal amount you're spending in premium. It's just like, you got to be in the carrier loves it, man. 17% loss ratio. I mean, come on. Why wouldn't we want you in our $50,000 deductible program?
You know, it's interesting. So most agents, when we start the training with captives, right? So for every dollar of spend, 65% is loss funds and 35% is operating costs, right? And those are generic numbers, but
I say it all the time. I say that all the time. Real quick, let me finish my thought pattern because I stopped for a second and then I forgot to finish. The reason I bring that up is specific to this account with the high out of pocket and the $50,000 deductible layer is we probably had 50 to 75 pages of loss runs to get through. And we got through them and we started going back and we put them into bands. 0 to 1, 1 to 2, 2 to 5. If you were there over 2 years, the number of claims significantly dropped. So that, you know, when you start looking at that, the question is, what type of standards do you have in place that you tell your subs they must adhere to? And what do you do to train them to get to that standard? And then how do they document that they met that standard when they're at the job site? You're spending all of this money for Service Titan or whatever your CRM is, and it's built with the capabilities for them to take pictures of everything they do and upload it. And this is the type of industry where there's a little bit of lag time on the GL claim. So it may be a month, 2 months before the claim comes back in just because of the nature of the business. There's not really a way to cut down the lag time. It's just inherent to what they do. And so they have no defensible position. But when you go back and look and you can see, you take that loss data and you stack it up and you see, oh my God, man, the people that are there 2 years, I mean, your point. It was exactly 2 years or less, and you didn't even realize that we were working on this. 2 years or less, it's like if we can fix the 2 years or less people and get them to be there for 2 years or more by actually training them and getting them where they need to be, this is it's
Yeah.
our bit. We make our business much harder than what it really needs to be. I
Yeah.
mean, that's the summary of it all. But to your point, I mean, that same number, 65% is that's typically what I use as the profitability threshold for a loss ratio for a comp carrier, right? If you've got a 65% loss ratio as a client, the carrier breaks even at that point. If your loss ratio is less, then they're putting extra money in in their pocket, which is why they're able to give you a dividend if your agent is able to go out and negotiate a good one for you. But they have to have that 35% to cover the fixed costs and the admin. The 65 is what they play with.
Yeah, I couldn't agree more. And it's funny. So you're obviously we know some of the same people. We having just recently met. There's a lot of crossover there. But what was interesting is that you're talking about prevention and containment, right, with your client about your sub agreement, primary non-contributory, all that stuff. That is so critical to captive success because if you're not trying to risk transfer stuff away from you as a business, and agents need to understand what all of that means. Like once you get this, it's a light bulb going off, right? For most agents who don't understand how contractual risk transfer occurs. But to join a captive, that stuff needs to be there, right? Because otherwise, we're going to sick Noelle on them. And I know
Well, I was going to
yeah,
say, and for those of you who missed it, you need to go listen
she's
to
awesome.
the episode with Noelle McCall because she
Yeah,
broke it down very well and actually gave a special offer on that podcast. But I mean, I've had several people inside Killing Commercial reach out, and I've had a direct conversation with at least one that's already enrolled in her program, and it got a deal done for him. Like
yeah,
literally was
yeah.
in her program for 2 weeks and went out and got a middle market account because of what he learned in her course on contractual risk transfer.
Yep, she is a true expert in it, and we have her consult in the captive world for us too. So I mean, she's worth her weight in gold without a doubt. Because look, you can get burned even though you didn't cause the problem if you don't have the paperwork right. The coverage triggers. It's all about the paperwork. What's the contract look like? So if you don't have that going, I mean, that drives directly into profitability as a captive owner. Um, what? Just to segue this real quick. Agents when we talk about captives, what I think agents don't understand the process more than it is the mechanism, right? The mechanism is, you're still going to get certificates, you're still going to have a policy, it's still going to have a familiar name on it with an AM Best A-rated carrier. There's some nuance to how the claims get paid, and whether it's like because we operate a quota share in addition to the traditional AB captive, which everybody's seen. If you've seen a captive, a group captive in the U.S. From the, we'll just, we know who we're talking about. That's an AB. There are other ways to do it, but I think agents really don't understand how the whole thing kind of comes together, right? And once you get clarity on that, you feel a lot more confident about, okay, I get this part. It's not this scary thing that I have to worry about or whatever. Like I can go learn it and talk about it, and I don't have to be the expert and be an actuary for crying out loud. And as long as you got good risk management practices for your clients, then they're gonna be really good fits, most of them.
Yeah, and I think, I do think that it's important for agents to understand enough about the financial piece of it too, right? Because
Yep.
I can tell you from being in the high deductible workers comp game where we had clients that were taking $1 million deductibles per occurrence with no aggregate on them, when we were writing master comp policies for PEOs. Collateral is what got the deal done a lot of the times, man. Being able to go in and um, know your loss data well enough to refute the loss pick that the carrier put out if they were open to that conversation, and then be able to negotiate the collateral based on those numbers. That's a big deal, man, especially when you got, hundreds of thousands, if not millions of dollars tied up because it just stacks year over year over year. And I can remember being in multiple meetings where we were negotiating for a $500,000 back for somebody who was a prospect. And we'd get the deal because we were able to free up some of the capital based on what we could demonstrate was really going on with the losses, plus our commitment to continue to do the things we were doing to clean up the book on the risk management side.
Yeah, I love that. Collateral, you, agents, well, explaining how you figure it out, right? And it depends on the model, but collateral is a security deposit, right? It's insures because the fronting carrier, right? So that's the insurance company that's going to be on the paper, for the audience who may not know anything about how this works. So the fronting carrier is going to be, they're going to take all the losses above the retention, but they have credit risk. So if the captive, for whatever reason, can't pay its bills, they're on the hook for that. So they want to make sure there's enough money there that they can go get based on loss history. You're exactly right. And so collateral for the traditional AB captive can be very expensive. It is a true barrier of entry for most businesses in the captives versus the quota share. That collateral's 15 to 20% of premium, depending on how you set it up. And it's much more attainable because you're sharing risk with a quota share layer with an AM Best A-rated partner. I don't know if you know how much about quota share, but I'm super excited for our next launch. That's quota share.
Yeah, no. I mean, I think you did that. Why don't we do this for a second? Because I do think you started down the road, and I know that we're 40 some minutes into the podcast, and that's fine. Break it down for a second. Like, just start at the beginning. You have a fronting carrier, and
Yep.
I've seen Zurich and several others that are, the international carriers. It's usually the big companies that are the fronting paper for a captive. But maybe just talk about how a captive. And I'm also not asking you to give away everything you teach in your class. So if some of this stuff is overlap, please, just let me know. But I think that if you were to maybe just give them a little bit of an education on how a captive is structured, that people listening to this would find it very valuable. Because I don't feel like, and I could be wrong. I don't feel like agents often sit back and think about how insurance companies themselves are actually structured and how a captive would mirror that, right? And I actually made that the subject of my newsletter that I published on LinkedIn last week, 10 different metrics to measure a carrier by, but that was more from a financial strength and profitability and way to explain that to a client. I think next week I'm going to make the subject of it how an insurance carrier is actually structured, because I think if agents understood that it would make it easier for them to navigate some of the pushback they get from clients on different aspects, like, why is my premium going up? I've not had any losses, or there haven't been any storms in the area, or whatever else. And being able to understand how reinsurance and all of this stuff plays into it. So maybe just give them the foundation and say, look, if you've got somebody who we're going to put a captive together for, here's how it starts at the very beginning, and this is what it looks like through the process.
So thanks, Dave. So what we do it a little differently because most captive managers will open one up and they'll start with 6 or 7 members and trying to grow it from there. I've seen that. I've put clients in stuff like that before. We wanted to do it differently because we wanted to have all of our captive business owners ready to go. So we accumulate 50 members and then turn it on. And it does a couple things because it shows businesses as a group how much risk sharing, because the industry is not very transparent on risk sharing. We'll talk about that in a second. So then business owners can go in eyes wide open with this group. This is how much I would have profited, lost, depending on the year. And there's incredible transparency in that. But let's just talk about it. So we turn the captive on. Well, where's that captive base? What's the domicile? We're all based here in the US. So North Carolina is where our facility is set up. There's lots of great domiciles in the U.S. Tennessee, Vermont, Utah, Alabama's really hot and heavy. DC, the regulator and having a relationship with the regulator, very important. But we create an insurance company. It is regulated by the domicile, so it is a real insurance company. But unfortunately, that insurance company as a captive has zero credibility in the marketplace. So we have to go buy that. And when we say buy that, we have to go buy it from a fronting carrier who's got an AM Best A rating, who has billions of dollars, who has an incredible balance sheet and profitability, and they give us credibility. So when we pay that, we pay a fronting fee. And there's the negotiations, right, of how much that fee is going to be, and then how much retention the captive is going to hold on to. So we have traditional AB captive. We have three buckets of money: premium payer, right? So that's your client paying money into the captive. Then two, the aggregate of all the members together. That's the captive, right? And then the third piece would be the fronting carriers. So they're going to take anything over the retention. When we introduce the quota share, we bring in a reinsurance partner to share in the retention, 50-50, 75-25, whatever it ends up being. But that allows a lower collateral amount, right? Because now I've got an AM Best A-rated company that's in there sharing losses. And trust me, the fronting carrier loves that idea. Sometimes the fronting carrier and the quota share carrier are the same, could be. So that carrier or that captive, once we establish that fronting relationship, and that's kind of just like any other insurance company, they have an appetite guide, what they're going to do, what they're not going to do, what their reinsurance treaties allow them to do. And so the captive now has a life, right? You can get a certificate that says, whether it's Zurich, AIG. I mean, most carriers, domestic carriers, or we call them domestic, but U.S. carriers do fronting arrangements of some kind all over the place, right? You just don't hear about it. And then they may provide. There's two kinds of insurance that we add to the captive. We have specific and aggregate excess coverage, and that protects the captive in two ways, right? Say we all have a bad day and we have huge severity losses, or we have a bad day and we huge frequency losses. So it protects the captive from running out of money. And then so when a member has a loss, they have loss funds to pay. So depending on the model, they have loss funds to pay. When they run out of those funds, the other members absorb the loss up to the retention, right? So that's how you have to think about it. And so that's what we create risk sharing amongst the members. That's what creates it insurance in the eyes of the IRS, right? So we have to have something that is risk sharing amongst unrelated entities. And so that's really a captive. I mean, the money flowing, whether it comes from, it goes to the carrier, the fronting carrier, and then gets seeded back. When we say seeded, that word means just it's just given to, it's a flow through back to your captive for whatever amount of money to pay losses. It's not over, like, I don't want to overly complicate this, in fact, David, because you can sit through a 72-page slide presentation like I've done before I opened Captive Coalition and look at sample data for members and go, what is this all about? Like, this doesn't make any sense. Your client's looking at it going, this absolutely they don't even know what their GL policy does, much less how the captive risk transfer.
Yeah, they're surprised at audit every year because
So
we
true.
don't publish the rates and the projected exposures on the deck page, right? So it's always a surprise at audit. Let me tell you what I heard. I'm going to make it as simple as I can.
Please, I love that.
And then correct me if I'm wrong. So you have fronting paper and you purchase that because they're going to take care of any risk above and beyond whatever the retention is. Okay. And then you have reinsurance that you buy to do a quota share of the losses inside the retention. So let's just say your retention's $100,000. What's a typical quota share? Is it 50-50? Is it 75-25?
Yeah, retention to be higher with that. So you'd have $500,000 retention and you'd have 50-50.
Got it. Okay. So it's 50-50. Now, you could not have that reinsurance come in and be responsible for everything up to that 500,000, but it
As a
probably
captive.
makes correct.
As a captive, right? So people have to understand that your client may only be paying 300,000, which means they've got 190,000 in loss funds. Well, when your retention's three, four, $500,000, they get wiped out in a loss. Who else pay? Who's going to pay for that?
Correct. And that's what I
Your
was
other
getting at. It
members.
makes more
Yeah.
sense to spend the money to have the quota share. It's a little less risk,
A
number
lot less.
one. And number two, I would imagine, and I really don't know the answer to this, but I would imagine it helps you with what you have to collateralize and pay into the loss fund if you're sharing in that risk with the reinsurance, right?
Yeah. So if you go to my website and you click on agent tools and you go to the pricing calculator, that shows you the collateral for an AB captive, and it's two times. Most people in the industry are pricing that at two times A fund. So it's 65%, right, of your gross premium is your loss funds, and 70% of that is your A fund or your frequency fund. So on a $250,000 premium payer, and I just because I have the model for these numbers, your collateral on an AB captive is $227,000. On a quota share captive, it's 50 grand.
Mm.
So it's $170,000 cheaper because you're willing now, because the quota share, you're giving half the loss, but you're also giving up half the underwriting profit. And in my opinion, and agents and business owners have confirmed this, because coming into a new captive, right, or not a mature captive, I would say, you're all about the first couple 3 years of trying to get your premium down, because now we're tying your renewal to your losses and not the market. We don't have to worry about the traditional market anymore. The actuary can weight that. So you'll see premium savings year 2 and year 3 before you start to see distributions in year 4. So what you get is you got a cheaper way to get in, and then you start realizing these premium savings. And then so by year 7, the members could decide, you know what, we're doing great. We got 20 million in surplus. We don't need this quota share. We can spend some of the house money that we have saved up. We don't need quota share anymore. That's my vision for how this works. Is it allows guys to get into a captive with a lot less risk, a lot less collateral, and then learn what it is to be in the captive, be really comfortable, super tight, and then at some point, if they decide to exit from the quota share as a group, they can do that.
Yeah, and I mean, I think that would be the ultimate goal, man, is to just keep stair stepping up through until you're finally in that kind of a situation. Even at the agency level, we have the ability, we have carriers that offer a protected cell captive option for us where I think we pay 50 grand to get $1 million of capacity, and it's got a separate underwriting code than what your regular um, appointment with them is. And you do your own field underwriting, and you can cherry pick, right? The business that's the absolute best and cleanest, and you project probably will continue to perform well. You can pop into that arrangement where you're in this protected cell captive. And the difference is you pay the 50 grand per million one time, then it's literally the policy still works just like it normally would for the client, but you have the ability to not only get your commission, but you also still qualify for your profit sharing with that carrier. And to your point, you get I think it's like 4 years, probably 4 or 5 years down the road, you can then start sharing in the underwriting profits. Now, that's also a quota share basis. But if you're an agency who wants to figure out ways to maximize your revenue, but you don't have accounts that are big enough to put into captives, it would be worth talking to your carriers and finding out whether or not they have the ability to offer you an opportunity to have a protected cell captive under their umbrella, because it's a good way for you to make a little bit more money or even a lot more money on your clean business. What it isn't is the pen. Like, it doesn't mean, oh, we've got a protected cell captive, so our appetite just got better. No, your appetite probably should restrict when you get that,
Strength.
right? and then and you're actually going out and making educated decisions because you're playing with a little bit of your money now instead of just the insurance companies. But that's an interesting vehicle that I know several agencies have taken advantage of that's really made a difference. And it's not a horribly difficult model. It helps you learn a little bit more about how all this stuff works. So
Yeah.
listen, we've been going, we're at 3:55. I've got another recording here in 5 minutes. How do we want to wrap it up, man? How do they get a hold
You
of
know,
you? How do they find out more and
yeah.
give them whatever you want them to know on your way out?
Yeah, let me go through the 5 tenets of Captive Coalition. Essentially, we
Sure.
built the entire business on this, right? So number one, we only work with independent agents, right? So if you're one of the ABC alphabet brokers, I can't help you. Now, if your agency sells to one of those, we still honor them in the servicing of those accounts. They just can't bring new business into our captives, right? Simple as that. Number two, we don't do the BOR thing with a few exceptions. I have to put that caveat in there. You can't get accused of misrepresentation, fraud, et cetera, things that you lose your carrier contract or license with. Number three, we don't let business owners come to the captive without an agent. Absolutely will not do it. Business owners call us all the time. And when I get that phone call, I qualify the client, see what they're all about, who their agent is. And if they don't have an independent agent, we actually refer them out to somebody in our network. Typically, it's geographically. And number four, the agent that they're bringing in to the captive is not me, right? That's super important. We don't have an inside producer. There's none of that. So, I would never bite the hand that feeds me because we want agents to know rule number five, it's always your client. It's never my client. I don't ever see it that way. You're the agent. You're my client. We work together. I'm bringing captive insurance to you. You're going to bring that to your client. We're going to do that together as partners. So they can go to captivecoalition.com. We set up a captivecoalition.com/ welcome killing commercial URL. So you can check that out. And then they can click the join. They get a free learn membership because of you. Free learn membership into Captive Coalition. They get all the tools, process, how we do it, what we do, learn about captives for free. And then there's an opportunity for them to submit a client if they're interested in talking about it.
There you go. Listen, if you are driving down the road or bouncing on the treadmill, either way, we'll have all that information in the show notes for you. You'll be able to click and get there directly. I encourage everybody to go to the website and at a bare minimum, check it out because, again, you can either have these conversations or you can learn about them after your client leaves. It's really the way that it's working right now. So many people are looking for ways that to improve efficiency financially, and your best operators should never, in my opinion, be in a guaranteed cost insurance program, period. I mean, even if you can move them into a high deductible, I want them to take as much risk as they're willing to. But we didn't even get into the tax advantages that you can get by having a captive and some of the other things, and we'll save that for the next time you come on. But I do encourage everybody to go over and check out Captive Coalition, reach out to Warren if you have any questions, and take advantage of his generosity. He gave you a link to go there and have a free account with them. So make sure you take advantage of that, and we will catch you next time. See ya.
Thanks, David. Talk soon.